Well, thank you, Dan, and the Chamber of Commerce for the invitation. It's so great to be here, to be back to Ames. I found myself 20 years ago at Iowa State, coming from Bangkok, Thailand, and I thought originally I was going to be here for 2 years, ended up staying here for 7 years, so longer than expected, and I spent all of my time in Iowa. So when people ask me where I'm from, I say I'm from Iowa, kind of adopt this as my hometown. They're like, no, where are you really from? Like, okay, Thailand. So I was born and raised in Thailand. Any of you guys heard of the river called the Mekong River? So that's a river that goes from China all the way to the South China Sea. And it was just the farthest remote part of Thailand. That's where I'm from. And my husband, he's from Marshalltown, Iowa. So I told him, you know what? There are 30 million tourists in Thailand. Maybe one make it to my hometown, that's you. So that's how remote it is. I left Thailand, over 20 years ago to come here. And I still remember when I left Thailand, we were still harvesting rice and planting rice by hand and using water buffalo. We see that plow pulled behind water buffalo in the field. So imagine coming from that, coming to Iowa and see that big John Deere combine went through the field. That was just an amazing moment. So I would just feel really happy to be a part of this company that has really have a great mission to feed the world, to fuel the world, and to provide shelter to the world as well. So a little bit about the company here, John Deere. All of you guys, I'm sure you have seen. If you want to get into buying some lawnmower, I think Rob, you said you just bought you have some of those. So meet me after this as well. So John Deere, we have over 80,000 employees globally. We have in the US, we have about 2,000 dealers, and we serve customers over 100 different countries. And within Iowa and bordering states, we employ about 20,000 people here. So definitely, we are a big global company, and you think about our mission is to use technology in our machine to help customers every day to unlock that economic value, to make more profit, and we do that in a sustainable way. So it's really a great mission, and I'm excited to be a part of that. A little bit here about what are we expected to hear in the next maybe 45 minutes, and I think Jan told me maybe leave some time for the Q&A. If you have hard questions, I'll have to get back to you later on in the week. So what are we gonna talk about today? Maybe a little bit look back. What happened in 2023, and then maybe some perspective in 2024. But I do want to remind you though, I'm an economist, right? An economist forecast 8 out of the last 5 recessions. So that's how good we are. So you take that, you think about it, but the key important thing is this is the baseline that we hear from the market. So that helps you plan the business, but you have to make sure you also continue to be monitoring and also make sure you pivot when you can. We'll talk a little bit about what do we see the ag economy. We just have a conversation about what's the situation in Ukraine and how things are gonna pan out. So we'll talk a little about that and what to watch for and my ask for you. This plot is showing you the Fed fund rate, and this is how good, if you think the market know what is going on. The little line shows the futures market for the Fed fund rate. So you can see that if you believe in the market efficiency, market is wrong. I haven't seen the little dotted line has been the same with the actual number that happened. So the market, it's kind of hard to see what can be really trusted. I think it's an eye-opening here. And what I want to do next is I want to turn all of us into an economist for a second. And some of you that might remind you of all the bad memories you had back in college days. I don't know, some of you took my class back at Iowa State. That might remind you of that. But I want to kind of give this framework on why do we think 2024 is going to pan out the way it is. Because of all this economic environment that's happening. So first start, it doesn't matter if you are on the transition, inflation is transition or it's not, or it doesn't matter what it is. We started because of COVID. All of us stayed home. All of us are part of the problem because I got a credit card. My husband, every time he spent more than $200, it rang on my phone. So I know how much he spent during the COVID. All of us was a part of the problem. We didn't go anywhere. What did we do? We went out and we spent the money. So we had that inflation. And the government, Also spend a lot of stimulus money there as well. So when we had the inflation, that is one of the biggest fear of the central bankers. We have seen when countries had hyperinflation, it's really hard to bring it back. So what the Fed does, then the Fed has to raise the interest rate, because when you raise the interest rate, then what happens? It makes everything more expensive. If you want to go and buy a car, you want to go and buy a home, when you go see the interest rate going from 3% mortgage rate up to 8%, that decision is a little bit more difficult, right? And the companies, when you think about your investment, when you see the cost of doing investment of your business is going up, that's why we're going to see some of those postponement. We see some of those slowdown in the economy. And that's going to bring the economic slowdown is going to happen. We have seen this rate hike happen 18 months now. But the impact of those is not going to happen immediately. So what's going to happen is we're going to start to see this economic slowdown, and that's going to bring the inflation lower, and that's going to bring the interest rate lower. This is where we are in 2024. We're going to start to feel that more. I know there's going to be some sector in the market that's going to hurt more than others. For example, if you're in the housing market, 70% of the homeowners have their mortgage locked in at under 4%. So think about that a little bit, right? I bought my house, it was 3% mortgage. So when the mortgage rate at 7 or 8% today, am I going to sell? No. And that's why the housing market has been tight, and that's why we're seeing a lot less of those home sales. So those are going to be something that's probably going to be a little bit more subdued in 2024. But there are some bright spots here, and I'll talk about that. And the divergence in the region is different as well. If you look at Ames, your unemployment rate, your economy is definitely doing better than the national average. So what might we expect in 2024? First, the soft landing conversation. Traditionally, economists say if we see the key canary for the recession is when you see the inverted yield curve. Anybody ever heard of the inverted yield curve? It's been inverted for about like a year and a half. It hasn't changed. So the probability of soft landing has come down significantly. Today, Goldman Sachs put that at about 15% that we're going to have the probability of recession, not the softening of recession. Today, Goldman Sachs say about 15% we're going to see recession over the next 12 months. So it's come down significantly. And you look at this graph here, the green line, that's the inflation, right? And then the yellow line, that's the interest rate. When you see the interest rate increase significantly, the highest pace we have seen in recent history, we saw those inflation come down nicely. And during this entire time, the unemployment rate in the US hasn't really changed. It's kind of been around 3.5%, maybe 3.6, 3.7. It hasn't gone above 4% yet. When you see that's a hard landing, that's when you see unemployment spike up, but we haven't seen that. So you ask me how the Fed is doing, I say they did pretty good job so far, right? Now, you saw the inflation in the last slide. This last number, inflation, this is it should be 3.4%. That's the latest that just came out in January. 3.4%. Yes, it's better than the 9% that we saw not too long ago, but it's not back to the 2%. What is driving that? So if we break down the inflation, well, my husband, I can see him stop buying stuff because the durable goods inflation's been coming down, that yellow line, people stop buying things. And then you see what else is coming down is the inflation from the energy side. When we saw the war broke out between Ukraine and Russia, that energy inflation, which is representing on the non-durable good, that went up, and then it's been coming down. Even with the tension in Middle East today, we haven't seen oil price gone up. So that's kind of been under control for now. So what is really holding inflation at this high level is the service sector. We have to admit that all of us didn't go on vacation for a long time, so we can kind of went out to restaurants. We kind of went on that trips that we haven't taken in a long time. The big part of that is the service, the hospitality sectors, and also the wage. Those are what is driving that service inflation, and also the rent as well. But we do see the leading indicator that the rents is coming down. We think that the labor market, which is the key cost, of the service sector. I think that's moving to the right direction, but it's still really tight. If you look at here, this is labor force participation. So how many people working in the labor force right now? We're going back before COVID, we are over 63% people working participation. Now, we haven't gone back to that level yet. So that's why you talk about, oh, we can't find workers. Why is that? People hasn't come back. Why haven't they come back? If you break it down a little bit, working age people between 25 to 55, we are all coming back. The people who haven't come back, there are key two groups here. 55 plus, we have seen people retire early. They have time to think about their life, what they want. So they maybe choose a different life. So we have seen that group hasn't come back. The other group that hasn't come back is that 20 to 24-year-old, especially male. I don't know, in your basement, you find them. Those hasn't come back. So maybe they go back to school a little bit longer. Maybe when that happens, the market adjusts a little bit. But those are the two key groups here. So that's why the market continues to be pretty tight. Going forward, the Fed do want to kind of, because they want to bring down the inflation, right? So they want to create that slowdown. So we do expect to see the inflation, the unemployment rate goes up. The market's gonna get looser. I think the labor market has to get looser because of that. The forecast right now for the interest rate, we expect to see that coming down in 2024. By the end of this year, maybe come down 75 basis points. That's the kind of number that I heard. Maybe that happened in March, but based on the employment number and also the inflation, it might even not happen until like May. So we expect some of those to come down. And if the inflation is continuing to come down like that, we'll see that interest rate coming down as well. Now, people ask, are we going back to the pre-COVID level when you have the zero interest rate back, over the period of the 10 years that we have really low rate? I would say it will be hard to come back to that era. Even if we see the interest rate coming down, it will be difficult to see that. The new normal is what we had pre-pandemic wasn't the new normal. That was a time where we tried to bring the economy back from the great financial crisis. So when we see those coming down, the long-term rate is likely going to be higher than what we have seen before pandemic. What are the key risks? The key risk here, well, the situation in the Middle East, the supply chain situation, because supply chain has improved significantly. Now we have the situation in the Red Sea, we have Suez Canal being blockage there. Boat has to sail around the continent of Africa. That adds, 10 days, 15 days to the journey. If you need your parts, what do? You have to expedite it. It's more expensive. And otherwise, you can wait, but then it's still more expensive to wait for that part. So that's the key risk here, and also geopolitics, including what is happening in the US election this year too. So right now, based on the oil price, anybody surprised why we haven't seen oil price went up after we see the Middle East situation? In the US, we produce most of our oil domestically from the shale. So what's happened there right now, the market thing is gonna be contained, but the market is not always right. So that's something that we're keeping an eye on. So all in all, that's why, yes, we see the interest rate is high. That's by design, by engineering. We want to bring the slow down the economy. And likely so, we're gonna see economic slowdown. This is a consensus forecast, is we're gonna see slowdown. We're gonna feel it compared to last year. Right now, this is the economic growth, about 1.5% GDP in the US. And that is lower than the long-term rate in the US, about 2%. And we are not alone. The US, Canada, Europe is worse than us because they had higher energy price. And in the US, we lock in our mortgage rate for 30 years. They're not like that in Europe. They lock in at a shorter term, so when their loan roll over, they have to pay a higher rate. So that's why they're gonna feeling more than us. But we're gonna see that. We're gonna start to feel it this year in 2024. But again, different sector could be a little different depending on where you are. I'll give you an example. If you look at manufacturing, I think there's a big new trend that happened in the US policy, is we call that the new industrial policies. Because of the IRA Act, Inflation Reduction Act, and also the CHIPS Act, Those are creating a new breadth of the tailwind for manufacturing and also for semiconductor. You look at that, manufacturing job has declined constantly since the 2000. And now you have seen, it's kind of hard to see, it reached the bottom right in 2010. And now we are at the highest point in the last 10 years. The investment in manufacturing is significant. If you're doing some work for factories, we're gonna notice that. I know there's some sector of that, commercial real estate, those gonna be a little tougher, especially I can see that in Chicago where I located that. But in manufacturing, you can see we have seen significant investment happen because of the IRA Act and also because of the CHIPS Act. And manufacturing job openings right now, yes, it's been coming down. So yes, the market is still tight. It's hard to find people. But if you think about what you had been 12 months ago or 24 months ago, things are improving because we have seen less jobs opening. We have seen job opening decline constantly. But if you compare back to where it had been, that 500,000 number is still a really big number, especially in this environment where we see big money coming into manufacturing. We see labor force participation is lower. So we're gonna see that market continue to be tight. And long-term demographic is not it's gonna be tough because more people is gonna be retired. We saw participation is lower, and I show you all this. And the birth rate hasn't changed in the U.S. So how do you deal with that situation? This tightness in labor market is going to continue to be with you. How do you deal with that? Do you take care of your employees? Do you give them that flexibility that they're looking for? At John Deere, we have to go out all the way to high school kids to kind of talk with them about manufacturing, about our company in order to get the awareness out there. So those are the things that we do and be proactive in how do you retain your employees, because this kind of issue is not going away anytime soon. So with that, the economy overall is going to be a little bit slower in 2024, in the next 12 months here. That's our baseline forecast. What about the ag economy? How does that work? This story hasn't changed. Even though we see China population is declining, but globally, we're still gonna have more people on the planet Earth. We're gonna have 2 more billion people by 2050. They still need food, they still need fuel, and they still need clothes and shelter. And agriculture, it's a global market. This is showing you that if you look at globally, there's not a lot of area that can produce food in a productive way. We, in the heartland, in the Midwest, Corn Belt, we are very fortunate to have really good soil here. In South America, in Argentina area, that's not a big part, and also in the Black Sea area as well. So those are the key area that can really grow food and grow it productively. It is a very competitive market. You look at the acreage of key crops, think about corn and beans in the US. Over the last 20 years, we only see that number increase about 3%. Look at in Brazil, over the last 20 years, they almost doubled their land that come into production. Europe actually declining in their production. Russia increased significantly. Argentina was up almost 50%. Australia, Ukraine, everybody has been stepping up in producing more crops here. We used to be a key exporter of corn in the US. We used to export about 64%, have market share of 64% in the US, exporting into the corn world market. And now we're at 27%, that red bar. Who else is coming to fill our place here? Brazil and Argentina are now key exporters for corn. But that doesn't mean it's a bad thing. You know, you look at where do we use our corn? We use it to make ethanol. More today, every 3rd row of corn that's grown in the US go to ethanol. So it's not a bad story here because we're increasingly relying on domestic demand. You look at soybeans. We used to be a key exporter of soybeans too. Today, Brazil took our place there. And increasingly, more soybeans are being used for domestic crush to make biofuel as well. And I'm going to talk about that because those are the key important thing that is going to be, it feels a lot like what happened in ethanol boom in 2005. So I'll talk about that in a little bit. But more and more soybeans being used domestically as well. Wheat, this is a big deal. In majority of the world, they use this as their key staple. You can see US used to be a key exporter for wheat. Now that we diverted acreage to corn and soy, we have less acreage, and we have a lot more players in this market, Russia, Ukraine, and also European and Australia as well. It is not only global competitive, but it's also a cyclical industry, right? We've seen what happened between 2000 and 2012. We have seen significant increase in corn prices over the last, during that time because of, I would argue, two things. One, we have seen the increased usage of biofuel. Now we have, like I mentioned, 15 billion gallons of corn, of ethanol coming into production. The other part is China. During that time, we saw 1 billion people went from extreme poverty up to middle class. So they consume more pork, and therefore they consume more corn as well. So that's why we see that corn price run up. And we have seen this cycle gone through, you know, we call that the super trough because we saw that significant drop in corn prices. But what caused the recent run up in corn price? Anybody want to take a guess what this might be? Hawk Hotel. Yes, someone been following the ag economy here. In 2019, China lost significant amounts of their pigs to a disease called African swine fever. So when they're rebuilding their hog herd, they put them in this kind of hotel. You know, you can kind of check in, but you can't check out kind of a hotel. Why is that significant for the global market? Because when they used to have the hog in the backyard, they feed them with food scrap. When they put them in this kind of hotel, they have to use more corn and more soybean. It's more systematic, like in the Western style. So we see significant increase in Chinese demand over the past few years. I know it may feel to me that the mainstream might be, oh, because of the trade deal that we had with China, they had to buy more of our corn and soybeans. But if you look at, it hasn't changed, and significant increase in that. So I think a big part of that story, that Chinese demand, it's just still a big part of that. And therefore, that's why we see demand coming back that helps with price. In addition to demand coming back, the past few years, we also have crop losses in many parts of the world as well. You remember what happened, what went through the racial wind that went through Iowa in 2020? That destroyed a significant amount of crops. We lost a lot of corn that year. And this year, yes, that's why price went very high. Over the next 12 months, we do expect to see some of those price moderations. So if you're planning, if you know farmers, that's going to be a time that is different than the last 3 years because we do expect price to moderate. Because even though we have a lot of news about the drought that happened in the US this past summer, we actually had record corn yield. It is hard to believe the technology, the breeding technology, the farming practices, the machinery, everything that farmers do can really make that corn become more resilient. So we actually see the record corn. We see Ukraine production is actually coming back better than expected. You know, this is how much they produce this year. We thought it's going to be significantly down because of the war in Ukraine and Russia. It actually came back almost back to the level that it was pre-war. It's a phenomenon, resiliency in Ukrainian farmers there. We have seen Russian production of wheat it's been really, really good the last couple of years as well. And right now, we hear a lot about the bad weather they have in Brazil, but they also have really good weather in Argentina. So all of these just lead us to look at the market right now. In the next 12 months, we are expecting things to moderate for farmers. Prices coming down compared to what we have seen the last 12 months. So that's why we expect that farming's outlook over the next 12 months is going to be a little bit more moderation here. But it's not all doom and gloom, right? It's, you know, we have seen expenses is going up as well, so cost is going up, and farm incomes therefore is coming down. So from the farmer perspective-wise, farm economy is looking to see some of those moderation. But there's some good news. There's some good news because if you look at where the input costs, fertilizers are key input costs into farmers' balance sheet. That cost was very high during the war in Ukraine and Russia, but now it's coming back down quite a bit. We're almost back to 2021 level, and many farmers are already able to lock in the price in the fall for their new crop that's coming in this year. So that's going to be helpful for farmers. And many of you might own some farmland here. Farmland accounts for 80% of farmers' equity. And farmland value has been holding up the value quite a bit. I know, it's just interesting to see that in Missouri that they can have higher farmland value than what we have here in Iowa, because I think our yield is definitely better. But 34,000 acres for farmland, that value has been holding up. Overall national average, the last couple of years, we have seen farmland value increase about 20%. And I have seen the last quarter that I saw the data is still holding up about 1% Q on Q. So that means the value has been stabilized and kind of holding up despite the higher interest rate. Here's just showing you that value in Iowa there. We're still up about 1%. And for you know, our neighboring states, it's kind of very similar compared to what we had been last year. And farmers' debt, and I talked with yesterday with our dinner here about the farmers' debt, farmer finance also looking better than what it had been the last 8 years. So I think those are the factors that's going to help farmers buffer the impact of that declining prices that we expect to see in the next 12 months. So yes, we see some moderation, but we don't expect to see that big drop like we saw in the previous trough. This is a big story here. I think we don't talk about that enough. You know, biofuel is, you know, all of us in Iowa, I live in Illinois now, sometimes it's hard to find ethanol blend and I'm trying to do that. So biofuel has been a part of this decarbonization story that we hear, because when you think about biofuel, it can be between 20% or 80% cleaner than fossil fuel. So because of that, therefore, there's some more desire or demand for biofuel to help with the sector that is difficult to abate. For example, think about the long-haul airplane aviation. It's really hard to be electrified. You think about the maritime, the vessel that go across the ocean, it's really hard to be electrified. You think about the off-road vehicle, like big tractors, it's really hard to use battery. So those applications are a key candidate for using biofuel. And therefore, we have seen significant interest increase in biofuel. This is an example of that. This is the capacity of renewable diesel. Basically, you can use soybean oil, vegetable oil, and you convert that into renewable diesel. And we have seen significant increase in that market to come into the next 4 or 5 years here. So that means that can create a good demand for U.S. crop producers. So that's why this is a good tailwind for our sector. Also, you think about, we have about 3 billion gallons of sustainable aviation fuel that that we would like to see by 2030 in the U.S. So I think that's another thing that can be used, that we can use ethanol to produce sustainable aviation fuel. So that's another good tailwind there. So let me recap here. In 2024, we'll see some of those slow down. The farm economies might moderate a little bit, but we have seen a lot of good tailwind that's coming through and something that can help buffer the impact for farmers. What to watch for? Well, on the left side, weather, I would say the price that we saw for corn and soys, that could change if we have bad weather again this year. But again, no. It has to be really bad to really change that. So, but we keep an eye on weather. Right now we have El Nino pattern. So it depends, many forecasts I see it might end in the next few months here. So we'll see how that goes. And geopolitics, I feel sophisticated to talk about geopolitics. It's not my expertise here. But you read the news, you know where those are. I should put a big red circle in the US because those are the key ones the way the election is going to go, that's going to have an impact on our policies, have an impact on our foreign policies going forward. So those are really big deal here. This decade kind of take us a little bit longer term here. What we talked about so far is what we expect to see in 2024. But beyond 2024, these are the D, I call that the D economy, that's going to come upon us over the next 10 years. Decoupling between the East and the West. We have seen China try to use the yuan, we used to use the yuan in their trading to move away from US dollars. I don't think that's going to stop, but I still think dollar is going to be the key currency for trading globally. But that decoupling is going to continue this decade. Deglobalization. You start to see that now, onshoring, nearshoring. Right now, you go down to Mexico, they have labor problems as we do. They have infrastructure bottleneck as we do right now because of that deglobalization, changing of the global trade. Demographic, we talked about that briefly in the US. That's a big problem elsewhere as well. So it's not just us in the US, other developed countries in Europe, in Canada, everybody has a very similar problem. And decarbonization, that's where the administration is moving, not just in the US, policies in Europe as well, is moving into how do we reduce greenhouse gas emission to decarbonize the economy. All of those are going to continue. We might see some of those slow down, but I think it would continue this year. All of these lead me to think that we have more inflationary pressure over the longer term. However, if you think about what is the most number one thing we talked about that your kids are playing over the last 6 months or so, that AI, that ChatGPT, I think those are one of the things that can help us increase productivities. In my mind, is not, I think of it as something to help augment your work. So that could be something that help offset this inflationary pressure that these trends in the longer terms would continue. So I think of that as a trend that could help the economy fighting the inflation because we can improve productivity from that AI technology that's coming in. So this is my ask for you. As you go out today, I know you're Ion. If you have a newer car, choose to use E15 when you can. Use more ethanol when you can, because that's when you support producers. If you like milk, if you have kids at home, buy more gallons of milk. I say almond milk, I'll count that as, that'd be okay too, as support the high value crop. Anything you can do to support farmers and producers across the US is good. If you are meat eaters, you do more meat because it takes more feed, it takes more corn and soys to raise meat. So hopefully you enjoy your food more when you get out of here. And if you're vegetarian, I'll take lentil soup too. Any of those would help farmers. Anything you can do. And I'm very pleased to see that you guys already have bacon served here. Put it in your drink. Do anything you can. Try that when you can. So let me kind of circle back. Yes, the market, I can show you what our perspective might be, but you saw the market is not always right. It's hard to forecast. So take this, think about how this could help your business or what you can do. What is your upside, downside? What's your plan to pivot? And also the economy, right now, we do expect things to slow down. We expect the ag sector to slow down a little bit, but we don't expect things to go off the cliff like it's just not off the cliff. And then finally, I ask you to, whatever you can to help farmers, support farmers, keep that. And if you are interested in buying any John Deere equipment, you can meet me after the presentation as well.